Okay, hello everyone. I hope you all are doing well. So we are here with the second day. Is my voice audible? We are going to start in around 2 minutes time. Okay, just waiting for more and more students to join before we proceed. I hope you all were part of yesterday's session as well. Is there anyone who missed the first class, the first session that was conducted yesterday? Anyone from you who missed the first session? Yesterday we had discussions over some topics which included dark pool trading, SPACs. We discussed how to apply Modigliani and Miller model in your spreadsheets, and we did similar discussions. Okay, so hopefully you all were present. There might be some students who missed yesterday's session. It was an important one, and it is now on Wi-Fi YouTube. It is available on YouTube already. Okay. Are you all able to see my WhatsApp status? I have shared link of yesterday's session on my WhatsApp status so that you all, those who missed the first recording, can actually watch that. Okay, so I hope that you all have the link to yesterday's session by now from my WhatsApp status, and those who did attend the session, I hope that it was helpful. It gave you more knowledge about some topics that were not discussed previously. Okay. So now, as per the request of the students, many of the students asked me that I should do something relevant to collars or interest rate swaps, something like that online. So every time ACCA issues mock exams, their own official mock exams. Do you guys have ACCA mock exams with you? Do you know that the December mock exams are on ACCA website already? Have you guys gone through the ACCA mock exams? Okay, do solve the recent 2 or 3 attempt mock exams. Once your preparation is 100% complete, answers are on the ACCA practice platform as well, and these are official ACCA mock exams. However, if anyone finds it difficult to download them, I will make these mock exams available to all of you by tomorrow day end. Today I have a couple of sessions after this one as well. So today the agenda is actually that we will be discussing March 24 and June 24 mock exams, and mainly those questions which involve interest rate swap or similar things, because students tend to struggle in this area. So that's what I am doing. I am pasting June 2024 mock exam question number 3 on your screens. I have already shared the PDF file of everything with you as well. So this is your June 2024 ACCA official mock exam question number 3 that we are going to do right now. Apart from that, I hope you all have received by now, you all have the link to the previous yesterday's live class as well. Okay, is the screen visible? Am I audible? Shall we proceed? Shall we start? Is everything good to go? All right. So let's start with this question. This question, and if you check the questions that are tested in AFM in the recent 2 years, you will find that they are very easy compared to the previous past questions. Anyways, it says a Stockway company is a large cosmetic company. Its treasury department uses a variety of derivatives regularly to manage the interest rate and commodity price risk. Stockway Company's chief executive has been considering how the treasury department uses derivatives. She understands that the purpose of derivatives is to hedge risk and wants to be sure that using derivative avoids financial risk as far as possible. Today's date is 1st of April. Stockway Company plans to borrow an amount of 36 million on 1st September to finance a major product development. This loan will be for a period of 5 months, although in recent years, Stockway Company has borrowed for periods between 1 and 3 years. So today is 1st April. Borrowing starts on 1st of September, and April, May, June, July, August. April, May, June, July, August. 5 months from today. Correct? Borrowing ends. This loan will be for a period of 5 months, which means September, October, November, December, and January. So borrowing ends on 1st Feb. If I'm doing something wrong, let me know. 10 months from today. Okay. Okay. After this, it is saying that Stockway Company's Treasury Department has decided to hedge the risk associated with this borrowing, as there is some uncertainty about how interest rates will change over the rest of this year. The current central bank base rate is 3.9%. Most prediction in the media suggests that it could rise by 0.5% by 1st of September. So there are two base rates. Current base rate is how much? 3.9%, and it is expected to increase by 0.5%, and it will be 4.40% afterwards. Although there have been a couple of predictions that the central bank base rate will fall, Stockway Company can currently borrow funds at a floating rate of central bank base rate plus 60 basis points. So the company can borrow at how much base rate? Plus 0.6%. Stockway Company's Treasury Department is considering hedging the interest rate risk by using an interest rate swap arranged through Stockway Company's bank. Okay. Now, interest rates. What is an interest rate swap? In an interest rate swap, there are how many parties? Two parties. What happens? One borrows at floating, another at fixed. Okay. Then they exchange their obligations. Okay. Bank is involved and bank charges fees. There are advantages. Okay. Or advantages: reduced total cost. A collar on options on interest rate futures. Then there are collars. What is the prime purpose of collars? Hedge normally just sell some options. Selling option means you receive premium. Purpose is to minimize premium cost, okay, or to reduce the premium cost. Then we have details about swap. Stockwick Company's bank has found a possible counterparty for a swap with the Stockwick Company. The counterparty can borrow at an annual floating rate of base rate plus 140 basis points or a fixed rate of 5%. Stockwick Company's bank has quoted it a normal fixed rate of 4.7% for it to borrow. The bank will charge a fee of 10% points to each party individually to act as the intermediary of the swap. Both parties would share equally the potential gains from the swap. So if there are any, okay, for this specific question, if we talk about interest rate swap, number one, bank fee is 10 basis points for each party. So in this question, bank fee is 20 basis point total. Okay. Secondly, benefits of swap are shared in a ratio of 50% each. Now, when we talk about benefits of swap, they can either be shared at 50%, 30%, 40%, 60%. You have to be very careful and you have to look into the question, what the question is specifically is telling you, what percentage is mentioned in the question. Okay, this you have to be very careful about. Everything is clear till now? Okay, callers options on 3 months September dollar futures, $1 million contract size, option premiums are in annual percentages. Now, some students are worried about the caller when there are more than one types of put and call option details given. You can go for any possible combination, but if you see the recent past papers, they give you one call and one put only. Okay. The current 3 month dollar future price for September futures is 95.62. Future and option contracts are assumed to be settled at the end of each month. Basis is assumed to diminish to zero at contract maturity at a constant date based on monthly time intervals. It is also assumed that there is no basis risk and there are no margin requirements. A, calculate in percentage terms the result of the hedging strategy that are being considered for the $36 million loan. If the central bank base rate rises to 4.4%, your calculation should demonstrate the rates at which the payments between counterparties should be made. Okay, now there are two parties, correct? One is our own company whose name is Stockwave. So let me write SW, and then there is a counterparty. There are two parties. Agreed? There are two parties, Stockwave and a counterparty. Do you all agree? And they can borrow at floating rate or fixed rate. Okay, what is the floating rate for SW? Floating rate for SW is the base rate, okay, base rate plus 0.6%. It is saying a Stockway company can currently borrow funds at a floating rate of central bank base rate plus 60 basis points. So this is base rate plus 0.6. And what is the fixed rate for Stockwave company? The counterparty can borrow at a, okay, Stockwave company's bank is quoted a nominal 4.7%. For the counterparty, it is 5%. And for the counterparty, the floating rate is base rate plus how much? 140 basis points. So 140 basis points is 1.4%. Do you all agree with this information that I have just mentioned? Okay, now what is step number one? Step number one is that you find which party shall borrow at floating and which at party shall borrow at fixed rate. Okay. Come again on the rates. Rates are, I have just copied them from the questions detail. They were given as it is. I have done no calculations at all. It is stated in the question already over here that Stockwave company can currently borrow funds at a floating rate of central bank base rate plus 60 basis points. Then for the counterparty, it is mentioned the counterparty can borrow at an annual floating rate of base rate plus 140 basis points. Then the fixed rates are also given for counterparty 5% and for the Stockwave company 4.7%. I have done no rocket science, just copied and pasted all the details over here as it is. All these values are already given in the question. Okay, all these values are already given in the question. I have copied them as it is, no change, nothing. Are we all clear till now? If there is any confusions, you have to let me know, please. If there is any confusion, please let me know. I hope we are clear till now. Okay, what is step number 1? You find which party shall borrow at floating and which party shall borrow at fixed rate. This decision is very important. Okay. So there can be, okay, one party has to borrow at floating and one has to borrow at a fixed rate. So for example, if SW borrows at floating and counterparty borrows at fixed, this is one possibility. Other possibility, SW borrows at fixed and counterparty borrows at floating. Okay. So if SW borrows at floating and counterparty borrows at fixed, the total cost will be base rate plus 5.60%. And if SW borrows at the fixed rate and counterparty borrows at the floating rate, the total cost is going to be base rate plus 6.1%. Okay. This is step number 1. Your exam questions may be done differently, but I am teaching you an alternative technique. Many students struggle in the exam technique, so you follow the steps that I am mentioning. Step number 1, you have to decide which party shall borrow at a floating rate and which party borrows at the fixed rate. So there can be two possibilities: SW borrows at floating and SP at a fixed rate, or SW borrows at fixed and SP borrows at a floating rate. Okay, what do you mean by if we are not told the preferred borrowing rate we assume? I did not get you. Everything is mentioned already in the question. Okay, now consider both companies as a single unit. Consider both companies as a single unit. Consider both companies as a single unit. What will these do? Will they go for borrowing base rate plus 5.6%, or will they go for base rate plus 6.10%? If you consider them as a single unit, if you consider them as a single unit, definitely they will go for a cheaper option. And the cheaper option is base rate plus 5.6%. So this is how you do step number 1. After doing step number 1, you will be able to actually know that how these parties are initially going to borrow the funds from the original, you can say, the banks or somewhere. Okay, so we can see over here that it is better for the SW to borrow at floating and CP borrows at a fixed rate. No, Haris, we will write base rate because it is a floating rate and your base rate keeps on changing. So we write BR right now. Okay, so now we know who is borrowing at which rate. Now, step number 2, strategy. What will be the strategy, overall strategy? Initially, SW borrows at floating and CP borrows at fixed. After that, they swap and SW ends with fixed and CP ends at floating. Why we are not told what counterparties preferred borrowing rate is, whether they prefer fixed or floating, so can we assume that they will borrow at fixed? We will never assume anything. It is a question of an interest rate swap. In an interest rate swap, you have to decide which party is going to do what. The steps for a swap are that one party borrows at a floating rate and another at a fixed rate. If the examiner also tells you that the counterparty is going to borrow at X rate, fixed or floating, and you are going to borrow at a floating or a fixed rate, then how is the examiner going to test you? In an interest rate swap, try to understand that this is what you are being tested. It is never mentioned in the question what is the preference of each party. You just need to make sure that the objective of the parties is to what? Minimize cost. The prime objective of the parties is to minimize cost. The prime objective is to reduce the interest cost. The prime objective is that some way or the other they are able to reduce their cost that they were able to get themselves using the technique of interest rate swap. Now, in the first step, what we did is that we identified what each party is going to do. Since the objective is to minimize cost, they will go for the lower option. So if SW borrows at floating and CP borrows at a fixed rate, the total cost is going to be base rate plus 0.6 plus 5%, that is base rate plus 5.6%. And if SW borrows at fixed and CP borrows at a floating rate, the net cost is going to be 4.7 plus BR plus 1.4%, that is base rate plus 6.1%. Since this is the lower value, they are going to enter into a swap, and the initial borrowing from whatever X, Y, Z, A, B, C, D, E, F, G bank that they are borrowing funds from, they will initially borrow at this specific commitment. Now, strategy initially SW borrows at floating and CP borrows at fixed. After that, there is a swap and SW ends with fixed and SCP ends at floating. Okay. Now, why will SW enter into a swap arrangement if it has to end paying a fixed rate? And we also need to ask, why will CP enter into a swap arrangement if it has to end paying a floating rate? Okay. So SW will only and only enter into an interest rate swap if finally it has to go into a fixed rate. It will enter into a swap if its cost is less than 4.70%. Do you guys agree? Objective is minimize cost. Objective is to minimize the cost. The prime purpose, the prime focus, the prime objective is cost minimization. You have to reduce the overall cost, and overall cost means that if SW will eventually end up into a fixed rate, SW itself, SW itself can borrow at a fixed rate of 4.70%. The only motivation, the only factor that can motivate SW to enter into a swap if it is eventually end up paying a fixed rate is that its total cost is less than 4.70%. Why will counterparty enter into a swap if it has to end up paying a floating rate? The only thing that will motivate it is if its cost is less than the eventual cost, the last and the final and the eventual cost is less than base rate plus 1.40%. Do you guys agree? Do you guys agree? Okay. Because in order to enter into a swap, in order to change your floating commitments into a fixed or a fixed commitment into a floating, there might be some motivation. Currently, SW can borrow at 4.7% fixed. So it will only enter into a swap arrangement if there is some benefit. Currently, CP can borrow at base rate plus 1.40%. If it is eventually to end up into a floating rate, it will only be motivated if the total cost is less than this amount. Guys, I need quick participation from all of you. I need quick participation from all of you. Please participate. Do you all agree? Do you all agree? This is the only motivation that they are waiting for. Okay. So now listen carefully. Now listen carefully. If SW ends up paying a fixed rate and CP ends up paying a floating rate, their total cost will be, if they currently do it without swap, their cost is 6 point BR plus 6.1%. Okay, if SW borrows at fixed and CP borrows at a floating, the current cost is BR plus 6.10%. So we can write one more question. Why will both parties enter into a swap arrangement if SW can borrow at 4.70% and CP borrow at base rate plus 1.40%? The total overall motivation is if their combined cost is less than BR plus 6.10%. Do you guys agree? Read these lines very carefully. First, I wrote what strategy they are going to apply. Then I wrote that if SW eventually has to end up paying a fixed rate, why is it entering into a swap? Because there might be some motivation. The total cost is less than 4.7. Likewise, CP will enter into a swap. If eventually it has to end up paying a floating rate, its only motivation will be that their floating rate cost must be less than base rate plus 1.4%, which they are right now paying, or they can pay themselves. So they both will enter into a swap if their combined cost is less than base rate plus 6.10%. These are individual, and when you combine, this is combined. These are individual, and when you add up, these are the combined. So that's what is happening actually. If SW borrows at a floating and CP borrows at a fixed rate, their combined cost is base rate plus 5.60%, which is less than the base rate plus 6.10%. So can you tell me what is the total advantage that they are taking? Total advantage. Total advantage is that instead of BR plus 6.10%, they are borrowing at BR plus 5.6%. That is, they are saving, or their total advantage is 0.5%, 0.50%. Okay. Now, as per the question's requirement, the advantage needs to be split 50-50. So advantage per party is 0.25%. Agreed? Yes, this will be shared equally between the two as per the question. Now the questions can differ. Every question will have a separate or a different model. Sometimes advantage of swap is shared 60-40. Sometimes advantage of swap is shared 30-60. So they can give you any specific percentage. Do remember that the sharing of the advantage is before payment of bank charges. If your question states that the advantage of interest rate swap will be shared as 60% and 40%, you have to make sure that you don't take account of interest charges. Before taking into account interest charges, you have to distribute the benefits. Yes, I can explain 6.10%. If, yes, as said, if SW borrows at fixed rate, it will pay 4.70%, and CP borrows at a floating rate, it will pay base rate plus 1.4%. So they will both end up with base rate plus 6.10%. 4.7 and 1.4 are 6.1. Agreed? All good now? Okay. So this is the total advantage, and the advantage needs to be shared 50-50%. Now we agreed who will borrow from the bank at which rate, how will the swap be done, and we have also calculated the advantage, and we have also calculated the split of advantage. Okay. Now SW and CP, there are two parties. If SW borrows at a fixed rate, if SW borrows at a fixed rate itself, not entering into a swap, it can borrow at how much? 4.70%. And if CP borrows at a floating rate itself, if CP borrows or the counterparty borrows at a floating rate itself, it will have to pay base rate plus 1.40%. But they are entering into a swap arrangement. They are entering into a swap arrangement because swap arrangement will give them an advantage of a lower cost of 0.25% per party. So advantage, the net advantage that they will get is 0.25%. Their cost will be 0.25%. So the final result must end up that SW pays 4.55% and the counterparty pays base rate plus 1.15%. Okay. We have not done the workings in between, but we have concluded that this is the picture. This is the final picture that both parties must end up at. Okay, so are we clear till now? Are we clear till now? Carefully go through this. Okay, there is a long question I need to read. So first we will find the lower combined cost at which they both parties swap, and then other remaining two rates are those that at which they find the loan and the higher and at which they get loan from bank. Am I right? Your question is really puzzled. Let me complete the workings and I will re-explain. Okay, total advantage is the difference between these two. Total advantage is the difference between these two. So the difference between these two is 0.5%. 4.7 minus, oh, okay. This will be 4.5. 4-5%. You are right. Okay. Now final table, step number 4 is your final table or final working. There were two parties, SW and CP. Everyone be fully focused over here. Everyone be fully focused over here. Everyone be fully focused over here. Then I will repeat everything once again and give you all time to copy as well. Tell me as per step number 1. Tell me as per step number 1. What have we decided? Initially, what will happen? SW will borrow at a floating rate and SP will borrow at fixed rate. Do you guys agree? Yes or no? Okay. Let's do step number 4 and then we will recap everything. First thing is that we all agreed that SW will borrow at a floating rate and CP will borrow at a fixed rate. Because if they do like this, their total cost is base rate plus 5.60%, which is lower than the other alternative that we had, which was SW borrowing at fixed and CP borrowing at a floating rate. So we agreed this, correct? Effectively, we agreed that SW will borrow at base rate plus 0.6%, base rate plus 0.6%, and we also agreed that CP will borrow at 5%. Okay. Now, is this borrowing between themselves? Is this borrowing between themselves? Does this mean that SW is taking a loan from counterparty and counterparty is taking a loan from SW? No. Okay. It is from some bank. It is from some particular bank. SW will borrow at base rate plus 0.6%. Counterparty will borrow from XYZ ABCD EFG bank from at 5%. So initially what they are doing is that SW is borrowing from the bank at a floating rate and CP is borrowing at a fixed rate. Okay. There was bank XYZ, bank ABC, bank EFG, bank ABCD EFG, any bank. Okay. So initially SW borrowed from a bank at a floating rate, which was base rate plus 0.6%, and a counterparty borrowed at 5%. Okay. Now do remember SW is in agreement with the bank. So SW will pay this cost to the bank. SW will pay base rate plus 0.6% to XYZ ABCD EFG bank. And counterparty will pay 5% to the bank. Do you guys agree? Both of them will pay to their respective banks. Bank is not part of the swap. But sir, over here in the question, there was a bank who facilitated the swap. It is possible that the bank from whom the borrowing was done is different, and the bank who was responsible to conduct swap between these two parties was different. Understand this fact. Okay, this is first commitment. You have a contract, you have a legal agreement with the bank for this thing. SW has a legal contract with bank that they will pay base rate plus 0.6% to ABC bank. Counterparty has a legal agreement with a bank that they will pay 5% to ABCDEFG bank. This specific bank, if it is same, even if it is same, it is a separate agreement. Separate agreement. Between whom? SW and a bank and CP and a bank. It can be bank ABC, bank DEF, bank FIG. It can be the same bank as the bank arranging the swap. It can be a different bank. SW may be borrowing from a different bank, CP may be borrowing from a different bank. The bank that is arranging the swap arrangement may be a different bank. So do remember that eventual commitment to pay bank base rate plus 0.6% lies with SW, and eventual final legal commitment to pay 5% lies with counterparty from whichever bank they borrowed the funds initially from. Are you all clear? Are you all clear? And the initial borrowing of SW is floating, and initial borrowing of CP is fixed. Now we also know that the final result will be such that SW will end up with a fixed rate and CP will end with a floating rate. And we also know that the final result will be 4.45% for SW and base rate plus 1.15% for the counterparty. Do you all agree? This comes directly from step number 3. This comes directly from step number 3. Now comes the role of swap. Swap is between SW and CP. They will do some exchanges between themselves. They will do some exchange of interest X, Y, Z, A, B, C, D between themselves only, such that the net cost of SW becomes 4.45%, such that the net or the total cost of CP or the counterparty becomes base rate plus 1.15%. Swap has nothing to do with the original bank. Swap is exchange between SW and CP. Swap is an exchange between the two involved parties only who agreed to enter into a swap deal. Okay. Now what will happen is that right now what is SW paying to the bank? Right now what is SW paying to the XYZ bank? It is paying base rate plus 0.6%. It is paying base rate plus 0.6%. Agreed? It is paying base rate plus 0.6%. Agreed? Yes. And what is the eventual result? The eventual result is that SW must end up paying 4.45%. Okay. So what will effectively happen is that the final rate or the final result is a fixed result. Okay. So as take a difference of 0.6 and 4.45. What is the difference of 0.6 and 4.45? Okay, let's add 3.85%. Let's add 3.85%. Let's add 3.85% to SW's cost. So now this becomes base rate plus 0.6 plus 3.85. Does it match this value? Base rate plus 0.6% plus 3.85%. Does it match this value? No. What is extra? BR is extra. So you subtract BR. Okay. If you have to come from here to here, you need to add 3.85 and subtract BR. If someone adds 3.85 to this value and subtracts BR, it will be 4.45%. Do you agree? In base rate plus 0.6%, if I add 3.85% and I subtract base rate, I end up with 4.45%. Agreed? Okay, why 3.85%? Because we are starting from here. This is 0.6. How will you change 0.6 to 4.45? How will you change 0.6 to 4.45? By adding 3.85. Correct? If I add 3.85 to 0.6, it will become 4.45. And if I subtract BR, so BR will cancel out. Okay. Likewise, this is 5% and this is BR plus 1.15%. Now tell me difference of 5% and 1.15%. Tell me difference of 5% and 1.15%. Is it 3.85% as well? This time we have to convert 5% into BR plus 1.15%. This means that we need to deduct 3.85% and we need to add BR. Got my point? If I subtract 3.85 from 5 and add BR, I end up with BR plus 1.15%. Do you guys agree? Now, what effectively needs to be done? What effectively needs to be done is that the parties between themselves do these exchanges. Now, what will happen? SW pays 3.85% to CP, raising SW cost by 3.85% and reducing CP cost by 3.85%. Remember, this is compensation between these or transaction. Remember, this is transaction between these two parties and nothing with original bank. Okay. Likewise, SW receives BR, okay, from CP, lowering SW cost by BR and increasing or raising CP cost by BR. Remember, this is transaction between these two parties and nothing with original bank. Okay. So what happens is that SW pays and CP receives 3.85% from SW, and over here SW receives, CP pays to SW. So whatever is paid to SW compensates this extra cost and you end up over here. How many of you are able to understand everything? How many of you are able to understand the swap? Two students, only 2 out of 80. 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22. Okay, so 22, 23, 24, 25. Okay, a lot of students are replying that they are clear about the mechanism of the swap. Now, obviously, once this video is made available on YouTube, you can recap, you can revise, you can re-watch this. Doing it again will consume a lot of time, but yes, you have to look into the recording. Yes, now comes part of the bank fees. Now this is the swap, and for the purpose of swap, the bank is charging us a fees of 1%, 0.1%. How much did the bank say? 10 basis points. So 10 basis points is effectively 0.1%. So this is between the two parties. Once you are done with this working, you can then add up the bank fees. Bank is someone who was facilitating you in the arrangement, finding the counterparty, making sure that the counterparty compensates you for the BR and you compensate the counterparty for 3.85%. So there was a bank fees as well. I recommend that you involve bank fees separately. At the end, it was 0.1% for each party. Again, bank fees can differ in a question. And after that, we can have a total cost. 4.45% is cost of interest and 0.1 for the bank charges. So this will end up at 4.55%. And BR plus 1.15% plus 0.1% will be BR plus 1.25%. Now this includes the bank fees as well. This below written mentioned values include the bank fees as well. Bank is facilitating doing documentation, being a mediator, mid party. What if after some time base rate goes very high and the counterparty says I am not compensating? So there must be someone in between to smooth out the transaction. Now this was the swap between the two parties. It has nothing to do with the original bank. Do remember, originally what will happen actually is that when SW receives this base rate, they will add 0.6% to base rate and pay to the bank, and 3.85% is being paid to the counterparty. Okay, now what will SW do? Let me explain something else. What will SW do? Pay how much to the bank? How much will it pay to the bank from it borrowed? It will pay base rate plus 0.6%. Okay, it will pay base rate plus 0.6% to the original bank. Original bank does not know counterparty. They are least bothered about your swap. So SW pays base rate plus 0.6% to the bank. Then what happens is SW also pays 3.85% minus base rate to the counterparty, and receives, okay, and pays 0.1% to the bank that facilitated the swap arrangement. Yes, they will be done in the same way. Okay, now this is what SW will pay. Base rate plus 0.6% to the original bank, 3.85% minus base rate to the counterparty, and 0.1% to the bank that arranged the swap transaction. Okay, this is how things are going to go. Now let's do one thing. Let's assume some base rates. What if base rate is, let's say, 1.5%? What if base rate is 1.5%? Let's say if base rate is 1.5%, how much will SW pay to the original bank from which it did the borrowing? If the base rate is 1.50%, SW will pay 1.5 plus 0.6, that is 2.1%. Agreed? Agreed, 2.1% to the original bank. How much will SW pay to the counterparty? How much will SW pay to the counterparty? SW will pay 3.85 minus 1.5, that is 1.35% to the counterparty. Oh, sorry, 2.35% to the counterparty, correct? SW will pay 3.85% minus 1.5%, that is 2.35% to the counterparty, and SW will pay 0.1% to the bank that arranged the swap. And if you check, it will end up at 4.55%. Do you guys understand this? If base rate is 1.5%, this is how things are going to be. Do you understand this fact? If base rate is 1.5%, SW will pay base rate plus 0.6% to the original bank. SW will pay 3.85% minus 1.5%, that is 2.35% to the counterparty, and SW will pay 0.1% fees to the bank that arranged the swap. What if the base rate is 3.85%? What if the base rate is 3.85%? What if the base rate is 3.85%? If base rate is 3.85%, how much will be paid to the original bank? 3.85 plus 0.6. 3.85 plus 0.6 is 4.45%. Agreed? How much will be paid to the counterparty? Nothing. How much is going to be paid in fees? 0.1%. So what is your total cost? Again, your total cost ends up at 4.55%. Agreed? And then there is a case, there might be a case when SW is actually receiving some amount from the counterparty. When if the base rate goes beyond 3.85%, for example, if base rate is 4%, if base rate is 4%, SW will pay 4.60% to the original bank. The counterparty will now pay to SW 0.15%, and 0.10% is the bank fees, and the total amount is how much? Total amount is again same, that is 4.55%. Okay. So technically, with the help of swap, whatever the base rate is, SW is sure that they have to pay 4.55% only. Are we all clear? All good, all done, all clear? Okay, so this was about, it is like forward, not really, because in a forward there is an agreement, and under the agreement you have a fixed rate. Over here for the counterparty, if you check from the perspective of the counterparty, what if you were counterparty? If you were counterparty, your rate was not fixed, but it was dependent on BR plus 1.15%. Yes, for you, it has been fixed at 4.45%. Also, there is a very less risk of default. That's why we involved another bank to facilitate the transaction, giving them an extra fees. Okay, so this was one of the parts of the question which stated you work out everything relevant to the swap. I hope many of you did benefit from what we discussed. Now let's come to the callers. If we talk about callers, we are worried that interest rates will increase. This is a case of borrowing. So if interest rates increase, what are we worried that? If interest rates increase, what will decrease? If interest rates increase, what will decrease? The future prices will decrease. So how can we make gain on futures transaction? How can we make gain on futures transaction? If future prices will decrease in the future, we will go for a put option or a call option. Okay, now again, this is an option. I discussed probably yesterday, or I don't remember actually. In case of options, do you do sell now, buy later, or buy now, sell later? Do you go short? In case of options, is there any purchasing of future contracts today? When did we discuss it? I guess 1 or 2 sessions back, or probably yesterday. In case of future contracts, you do sell now, buy later, or buy now, sell later. But in case of option, we leave the transaction at risk. We will go to the market on the day the option is going to be exercised, do the purchasing and selling. Okay, we will go for a put option. But over here, we are tested for a caller. We are tested here for a caller, correct? So in case of callers, what is the prime purpose? The prime purpose is that you minimize the premium cost. Okay. The purpose is that you minimize the premium cost. So if you are buying put options, you sell call options. Buying put will mean paying premium, selling call will mean receiving premium, correct? So in case of callers, the purpose is to minimize the overall premium cost. Now, what will we do actually is we will buy September put options at 95.50 for 0.234. Okay, we are buying the put options, so we are paying a premium of 0.234, and then we will sell September call options at 96 for 0.219 as well. So you buy put options, you pay a premium, but you sell call options, you receive a premium. Number of contracts, 36 million is the amount of loan, 1 million is the amount of each contract. Contract length is 3 months and the borrowing period was 5 months. So we always increase the number of contracts to reflect the time period. Agreed? Then this working I do a bit differently. What I do is that I write today's rate of interest is 100 minus 3.90%. Okay, interest rate, and I write the futures price. What was the futures price today? The current 3-month dollar future prices for September futures is 95.62. The current 3-month dollar future price for September futures is 95.62. So today is what date? Today is 1st April. Today is 1st April. Transaction date is 1st September. Future expiry date is 30th September. When futures expire, interest rates and future prices are same. There is no basis. Today's future price is 95.62. Today's future price is 95.62. So the basis, today's basis is how much? Basis is the difference between these two, so it is 0.48. Now, what will be the unexpired basis on 1st September? What will be the amount of unexpired basis on 1st of September? Can you guys tell me? Quick, 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 quick. Quick, 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 quickly, quickly, quickly. You know how we do it, correct? Okay. So calculate the expected futures price. Now I am giving you some work to do. Calculate the expected futures price. Can you calculate the expected futures price? Okay, what will we do is that total months April, May, June, July, August, and September are 6. So 0.48 divided by 6. And on 1st of September, 1 month is left. So this is 0.08. We expect that interest rates will increase from 3.9 to how much? 4.4. So this will be 100 minus 4.4, and the expected future price on that day is going to be 95.52. Okay, this is the expected futures price. This is the expected futures price on the date we have to do the borrowing. Okay, this is the expected futures price on the date we have to do the borrowing. Okay, so I feel comfortable making a table, but if you think you can do it like the examiner is doing, I don't mind. Now the premium cost, premium was given in percentage, so this was 0.219%, and this was 0.234%. So if it was in percent, you divide it by 100. This is what you are paying minus what you are receiving. This is the net premium cost multiplied by 1 million multiplied by 3 over 12 multiplied by 60. So your total premium cost is 2250. Do you all agree? Any problems? Okay. Now comes the decision. You have bought put option. Put option means option to sell something. Put option means option to sell something. Now that something is available in market for 95.52, you can sell it for 95.50. So will you do this silly thing? Will you do this silly thing of buying from the open market and selling it? No, you will not exercise the option. Where did you get the 96.1? 96.1 is the reflection of today's interest rate, which is calculated as 100 minus prevailing interest rate of 3.9%. Okay, that's how we are doing it for a long time. Agreed? Okay. And someone who bought a call option means option to buy. Will this particular person exercise his option? Will this person who bought a call option from you exercise his option? Give a logic, a rationale behind this as well. Why will he not call from you? Because you are giving him the same product at 96, which is available in the open market at 95.52. Agreed? Yes. So effectively in this particular question, is none of the parties is actually exercising their option. Neither you nor the counterparty. Neither you nor the counterparty. None of you are exercising it. No one is exercising it. Correct? All good? So eventually, no one is going to exercise the options, neither the counterparty nor you, and your final outcome will look something like this. This is your final outcome. You borrowed 36 million, 4.4 plus zero point 0.6. 4.4 is the new base rate, zero point 0.6 is the credit spread. You are borrowing for 5 months, so 5 over 12, and this is your premium cost. So your 752,250 is cost for 5 months. All good? Any problems till now? Clear? All right. So we are done with the treatments of options and callers and the swaps. Call by the way because he can buy at 95.52 instead of Suman, you are interpreting it wrongly. Exercise price is the price that was given to him at which he can buy from us. The market rate is 95.52. The market rate is 95.52. Okay. Market rate is 95.52. All good? Okay. Why is the annual effective interest rate often calculated in such questions? Generally, any company is interested in knowing what will be the effective annual based cost. Generally, it is what the companies are concerned for, what they are paying in terms of cost. So that's why it is computed. Okay. All right. Now let's move on. I shared 2 exam papers with all of you. I shared June 2024 and March 2024. If I skim through the paper, what I discussed right now is question number 3. Its name is Stoke Wake Company. You will also watch the recording again, read the question again. It is a good practice question for interest rate swap and collars. If we come to question number 2 is about adjusted present value. You can practice it. And if we come to the question number 1 is relevant to mergers and acquisitions area and some shares exchange and something like that. I have also shared the ACCA answers with you. In the last few days, I don't recommend you to write and solve rather than read and understand. Do the same past papers again and again. Yes, you need to write a couple of questions or even more than that, but not every question is supposed to be written. I also gave one more March 2024 mock, correct, of ACCA. So we have March 2024 mock exam of ACCA in front of us as well. If we talk about this March 2024 exam paper, in March 2024 exam paper, question 1 was Durang Company, and it is about international investment appraisal. Then the next question, which is question number 2, it was about the cash offer and the share for share offer and everything. And the third question is about the future contracts and call and everything. Okay. So this is something relevant to the hedging area again. But I hope by now you all are confident about hedging area. Okay, do you have December 24 mock exam answers? Yes, I do. But I will give them to you in a day or two. Okay. Now, if we talk about the questions of March 24 and June 24 mock, I don't think so that they were very difficult. Let's discuss this one more question. This is question number 2. What do you guys prefer? Doing question number 2, it is relevant to some mergers and acquisitions and everything. Or question number 3, which is relevant to, it is quite similar to what we just did about interest rate hedging. So where is your vote? Question 2 or question 3? Question 2? Okay. Without wasting time, let's discuss this quickly. It says Arneson Company is a listed wholesale company in the grocery sector. The sector is becoming increasingly competitive as global food prices rise, but customers continue to demand low prices. It has decided to vertically integrate into the grocery retailing sector. So we know conglomerates, horizontal integration, vertical integration. Then there are 2 types of vertical integrations, correct? What are the 2 types of vertical integration? What are the 2 types of vertical integration? Forward and backward, correct. So is this one forward or backward? Is this a forward vertical integration or a backward vertical integration? In this question, it is a forward because it is acquiring the retailer. The directors have identified a small chain of supermarket, Biggs company that could be acquired. Initial conversation between the 2 boards of directors have been encouraging. The directors of Biggs company think that their shareholders will like the culture and ethos of Amazon company and would be open to the possibility of a takeover. In recent years, there have been several mergers and acquisitions in the grocery sector, and premium to target company shareholders have averaged approximately 20%. What is premium? Premium is being a charge that is paid over and above the normal. It is above your market value so that you agree to merge your company or let us acquire your company. 2 alternative offers are being considered. Cash offer, either the company will pay cash and buy the shares, or there will be a share for share exchange offering 4 shares in the combined company in exchange for every 5 shares. Armature company has 100 million shares in issue, trading at 3.35. Its earnings were 27.92 million in the most recent financial year. Big's company has 60 million shares in issue and its earnings were 11.61 million in the most recent financial year. As it is an unlisted company, it should be assumed that a suitable PE ratio of Big's company is 10% lower than ARM's company's PE ratio. Okay. So using this specific data over here, can you tell me what will be the PE ratio of Armason company? Can someone tell me what will we do to calculate PE ratio? We have market price per share. We have to divide market price per share by earnings per share. Agreed? How can we calculate earnings per share? 27.92 million is the total earning. 27.92 million divided by 100 million. Am I right or wrong? 27.92 million is the total earning of a company. You divide 27.9 million by 92 million by 100 million. So 27.92 divided by 100 is 0.2792 per share. When you get earnings per share, what will you do? Market price per share divided by earnings per share. Agreed? Do you guys agree? And this is probably what is done over here as well. Okay, they have calculated total company's value of 335 million. Okay, come again. 27.92 million is the total earning. Okay, 27.92 million is total earning. How will you calculate earnings per share? How will you calculate earnings per share? Earnings per share can be calculated as total earnings divided by total number of shares. Yes or no? Oh God. Let me copy it. 1 minute. Wait a second. Listen. Shares. Shares are how much? 100 million. Earnings. Total earnings are how much? 27.92 million. So your EPS or earnings per share will be total earnings divided by total number of shares. Price per share is how much? 3.35. So your PE ratio will be price per share divided by earnings per share, which is around 11.99 or 12. And PE ratio of BRICS will be 90% of this, 10.8 something. Happy now? Quickly. Are you happy now? Okay. So what I did is that we knew total number of shares, we knew total earnings, we calculated earnings per share, we knew price per share. So price divided by earnings give you PE ratio of the current company. P ratio of BRICS company is 10% lower, so you multiply it by 0.9. On the other hand, you can use the total earnings of 27.92 and you calculate the total market value of entire company using 100 multiplied by 3.35 and still you come up with the same PE ratio. This time we have market value of entire company and earnings of entire company. So both the methods are acceptable. All good? Okay. So this is how we calculate the PE ratio, and P ratio of the other company is 90%, 10% less. So you multiply by 90%. Okay, moving back to the question paper. Okay. So you can see that they have, what they have done is actually part A was theoretical, part B, they calculated the total value of the company, and then 90% of Arneson's company's PE ratio, so 90% into 3.35, they did everything directly. We did step by step, everything is okay. Okay. Now, if the acquisition is successful, the directors expect that post-tax synergies of 2.98 million per year will be achieved, and that the combined company's PE ratio will be the same as Arson and company's PE ratio before the acquisition, that is 12. Okay. So effectively a very easy question. You compute the BICS company's total value. This is the PE ratio of 10.8. If you multiply PE ratio with the total earnings of a company, you get value of entire company. Are we all together? We calculated 10.8 as BICS company's PE ratio. If you multiply any company's PE ratio by its total earnings, you get total earning, you get total value of entire company, that is 125.4. And since there are 60 million shares, so value per share will be 2.09. Are we all clear till this point? Okay. It's very easy question, I believe. Now, for the combined company, P ratio will be 12. There is no change in the P ratio as stated in the question, that there will be no change. If the current ratio is 12, the new P ratio will be 12 as well. And for earnings, you add all the earnings because every company is together now. So if we check the earnings from the question, earnings of Armisons are 27.92. Earnings of BRICS company is 11.61, and the synergistic benefits of earnings are 2.98. So you add up all the earnings together and you multiply it by 12 to get the total value of the new company. Synergy benefits are calculated as the total value of the new company minus value of the individual companies before acquisition. So you come up with 49.7 million as the synergy benefit. Clear? Any doubts till now? Clear. Okay, now there were two offers. One offer was that you pay 2.40 for every share, which is valued at 2.09. So if you are paying 2.4 for every share, which is valued at 2.09, you are paying an extra of 0.31. And for 60 million shares, you are paying 18.6 million in total extra. I repeat, as per the first offer, you are buying shares of BICS company for 2.40 per share. Its value per share is 2.09 as stated over here. So you are paying 0.31 extra per share. So for 60 million shares, you are paying 18.6 million extra. Is it clear? This is the gain. This is the synergy that is flowing to BICS company. So if the total synergistic benefits were 49.7, 18.6 are flowing to BICS company and remaining 31.1 remain with Arneson's current shareholders. Okay, 60. 60 is the number of shares. Are you talking about 60? 60 is the number of shares. 60 million were the shares of the previous company. 60 million were shares of the previous company. All good, all clear. Okay, the second was share for share exchange. In share for share exchange, we were offering 4 new shares for every 5 shares held. So 60 million previous shares of the company multiplied by 4 over 5 gives you 48 million new shares. So now the new company will have total 148 million shares. 100 existing plus 48 newly issued. And out of total value, 100 out of 148 portions belong to current shareholders of Arneson, and out of total value, 48 over 148 portions belong to BICS company shareholders. So again, you make a similar table and you calculate the gain. You all can look into the answer, into the question, and let me know if there is anything that you need to ask. We just have 27 minutes left. I will appreciate if you do it quickly. Quickly go through everything. Quickly, please go through everything and let me know if there is anything that you need to ask me. Be quick so that we do maximum coverage in minimum time. Time is very important right now. It is very important that you cover the things in the least possible time. All good? How many of you are able to understand this question as well? Any issues, anyone? Please let me know. All good? Okay, so now I believe you all need to wind up whatever content you have on the portal. If you are enrolled student, we still have a lot of things. Do remember that I gave you all secret sauce yesterday. Do you all have the secret sauce? Did you all go through the secret sauce? Let me now go through the secret sauce before I wind up the session. And you have to make sure that you keep studying till the last day. Okay, you can ask your question since it is a individual basis question. You can ask it later. If it is relevant to the question that we are doing, you can ask right now. Is it relevant to something that we are solving in the class right now? Suman, you can WhatsApp me. Okay, this is the secret sauce document, correct? This is the secret sauce document, and I hope you all have this document with you. This is something for someone maybe who is struggling to take out time. So this is the minimum that you can do. Obviously, it also has a lot of things. If you look into the secret sauce document, you have some links to past papers and everything, then some other important links and everything. And this is the list of questions that you are supposed to solve at least. There are 15 points. One of them says you solve entire June 18 past paper. So effectively, there are 17 past paper questions. Okay. After that, you have something from the theory side, and then there are some topics and everything. So everything is mentioned over here in the source as well. And now, yes, Ramesa, you can type your question quickly and I will answer that. Do we have to solve December? Yes, why not? Do solve it. And also you have your mock grand revision and game changer coming, grand revision, mock debrief coming ahead as well. Correct? You all have that particular thing coming ahead as well. Sir Biso, how to calculate PA? Okay, you mean, no, it is already given. Okay, tell me the year of the question. I will share it. I remember in Legender we were supposed to add. Let me look at right now. In fact, let me answer you on the WhatsApp. It will be better so that this specific video is kept short and simple. Okay. I can discuss with you on WhatsApp. Okay. When on the mock debrief and grand revisions, I will announce the upcoming dates. It is most likely going to be coming Saturday, Sunday. Every Saturday and Sunday, I will ask the management to share timetable with all of you. All right. So thank you, everyone. Take care. Signing off. And please make sure that you complete the content on the portal. Yesterday's webinar is already uploaded. I have shared the links with all of you. Watch it if you missed the session. With regards to files, I am resharing the files, today's file and the other files. And I thank you. Take care. Bye.